All right, everybody. In this video, we're going to complete problem AP15B in Chapter 2. And so in this problem, we're going to be looking at a number of different transactions, business transactions, and inputting those transactions into T accounts to calculate the ending balances for all the T accounts and the balance sheet and income statement. And that will finalize the problem. All right, so a couple things too we need to actually input. Maybe it's new in this one. We actually have to put the account names in, so just something to watch here, but that's fine. Okay, so what we want to do here is we want to start with our beginning balances here. And one thing to notice, or to note in this problem, is that we don't have any beginning balances, because as this problem indicates, this individual opened this business on March 1st. So the beginning balances will all be zero, essentially. So we don't have to put any beginning balances in. But like I mentioned, we will want to put in account, T account names. So I'm going to go through and do that now. So we identify which are our assets and what's our liabilities here. So we have accounts payable. And one thing to note, you would actually kind of need to work through some of these problems to know unearned revenue, what the totals, the names of these T accounts would be for these different accounts. As you work through the problem, that's how you would know if you were going through. But I'm just going to go through and input those now, and then we'll work through and have the right T accounts for us there to interact with. So let me just put one more on the balance sheet side, withdrawals, and then on the income statement side we have revenue, service revenue. We are a service provider in this instance. Then we've got insurance expense, meals and entertainment expense. We've got miscellaneous expense. We've got rent expense. We've got salaries expense. And I believe finally we've got utilities expense. And again, you really would have to do the whole problem and work through it to identify what kind of accounts you need. I have the solution guide right here, and so I just kind of wanted to set that up ahead of time. It's a little bit easier as we work through the problem to be able to have the names and all that stuff. Okay, so now we've got all our T accounts named. Now again, this is the first month of operation, so we don't have any opening balances. If we did have a prior month, those would carry forward for our balance sheet accounts and give us an opening balance, but like I mentioned, first month in business, so we do not. Okay, so we've got 12 transactions to record here, and the first one notes that we transferred $30,000 from our personal bank account to the business account. So we have a contribution essentially in this instance, and so $30,000 is coming out of our personal, and it's going into the business's cash account essentially. So you're making an investment into the business, contribution into the business essentially, and we're going to debit to increase, or sorry, we're not using debits and credits quite yet, but we're going to increase that cash asset by putting it on the left side of our T account, and increase our equity by putting it on the right side, and we're in balance. Okay, so then we provided services for $3,000 cash. So cash increase, and we provided those services, and that's our service revenue. We've earned that cash, and we were paid when we earned it. The third transaction, we purchased office and computer equipment worth $8,000 on account. So good to note there, it's on account. So $8,000 And we have accounts payable, which is going to represent the future payments that we're going to need to make on that. This is our liability, what we owe. And we now own the equipment, our asset side. Okay, we paid $1,100 cash for meals and entertainment. So we're going to put that in the decrease side on the cash. And then we're going to record the $1,100 payment or the expense here in our meals and entertainment expense account. Paid insurance expense with $800 cash. So $800 decrease in cash. And then so that was 800. So then we've got our insurance expense account. We're going to increase that by 800. And this isn't prepaid insurance. Remember, this is just a payment of insurance expense. So if we had prepaid, a whole year in advance, we would need an asset account for that. But we're just paying 1 month's worth. And so that's why it's just an expense for the current month that we're looking at. Okay, then we perform some services for a client on account for $4,000. Oh, so we don't want cash, but since we paid it, we performed the services and will be paid later. We'll receive them later. We're going to record that as an accounts receivable to be received in the future, basically. And we still want to record the revenue portion just like we would regardless of whether you're being paid in cash now or being paid in cash later and just booking an accounts receivable now. Then we paid $600 for miscellaneous expense, and that was a cash payment. We record the miscellaneous expense portion. Received a utilities bill of $1,000 to be paid next month. So we got our bill, but we're not going to pay it now, so cash won't be affected, but instead accounts payable will increase to represent that we are going to pay that utilities bill in the next month, in the future. But we still record, but regardless of, because we're doing accrual accounting, regardless of when we pay the bill with make the actual payment, we're going to record the expense associated with that utilities bill in the month it was incurred, which in this instance is in March. So we record that expense now. We just do an accounts payable, which will later be paid down with cash in the following month, it said. Okay, and then we paid $1,200 cash for office rent for the month. So this one we're reducing cash because it is just a cash payment. We're going to record the rent expense, $1,200. We paid $1,000 to the assistant. So we have salaries, $1,000. That was paid. It just says paid. So whenever it just says paid, you can assume paid in cash, obviously. Collected 50 cents of the balance owing from clients for services performed earlier this month. So in this one, we're going to look at how much AR, we had 4,000. So if we collected half of that, then we have $2,000 increase, and we're going to reduce our AR by 2,000 so that the remaining balance of, the rest of the other half, 2,000, is still waiting to be collected, but we did get the half of it paid. And this is us receiving that. And then we received $1,000 for cash to be performed in the future in 3 months. And so we got the cash, but we have not yet earned that money. So until we earn it, it is still a liability known as unearned revenue. And so cash went up and unearned revenue also went up. The liability also increased. Okie dokie. So then I think that's all of our transactions for the month then, all 12 of them. And so then we need to go through, we have no beginning balances again. So really we're adding all of the increase side and then decreasing all the decreases. So 30,000 plus 3,000 plus 2,000 plus 1,000 minus 1,100 minus 800, so on and so forth. And so when you go through all the math there, you will end up with a $31,300 cash balance at the end. Here we had a 4,000, and again we reduced it by half because we received half of the payment. Just one purchase of equipment there. This one's easy math. items there to be recorded. Let's go through and just carry some of these down. We had no withdrawals at all, so we didn't take any money out of the business. We had 7,000 total revenue, adding those together. We're going to bring down the totals here. Note that there's nothing really to add, though. It's just bringing the totals down. Okay, and then we have totals for all of our T accounts. And then we want to take the totals from all those T accounts and summarize them so we can get for our income statement, our total revenue then is $7,000. It's up there. And then total expenses, we just need to add each one of our expense totals up. And that comes to 5,700. And if we take revenues minus expenses, which is either net income or net loss, depending on whether revenues exceeds your expenses. In this instance, revenues do exceed, so we have net income, and that's $1,300. 7,000 minus 5,700. And then we're close to being done. Now we just need to add up all of our assets. So if we summarize, we sum all the assets together, the cash, the AR, the equipment, and then we sum our liabilities. I think we got 10,000, it looks like. 2 liability accounts. And then we've got our total for capital, which is going to be the no beginning balance. We added 30,000 for the contribution. We added 1,300 because of the net income, and we did not do any withdrawals, so nothing there. So it's really just the 30,000 plus the 1,300, or in other words, 31,300. And this is, again, kind of easy math. 10,000 plus 31,300 gives us 41,300. And you can check and see, yep, total assets is 41,300, and total liabilities and equity is 41,300. And that shows that our accounting equation is balanced. And that brings us to the end of that problem. Thank you all so much, and we'll see you in the next problem.